Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Ryan McKenna. Ryan is the CEO of Griffin Global Asset Management. He's joining us for the purposes of our Aviation Leaders Report 2024. And I should say we're recording this in New York in mid-October. Ryan, first off, thanks again for giving us your time. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about Griffin?
Sure. Thank you again for including me. Always wonderful to join you guys. And it's been a very busy year for Griffin, candidly. We've been delivering lots of airplanes. We have been striking new contracts with airlines. We have expanded our business into engines as well. So we are, I think, on track to be, depending upon the Boeing and Airbus delivery schedules and what actually happens towards the end of the year, to be pushing towards $5 billion of new aircraft assets delivered. We'll see if that sort of happens, but certainly in the mid to high fours of what we should look like for assets under management. And I think the team has grown pretty meaningfully since the last time we did this. I think we're now pressing over 40 employees around the world, and continue to have an amazing partnership with Bain Capital that we set up a number of years ago. So continue to kind of keep our head down and stick to our knitting of originating brand new delivered aircraft from airlines and their OEM and the OEMs, and delivering them, in the 6 to 24 to 36 month sort of forward period. So continue to kind of plug away at a particularly low risk profile of brand new aircraft on long-term leases. So we have all new technology aircraft, all on particularly long leases. So I think our fleet average now is just over 1 year of age and north of 10 years of lease term remaining. So we had a big year for capital raising, of course. We debuted in the unsecured corporate markets. So did a $1 billion bond in late spring, early summer of this year. We engaged with our bank group to have our first unsecured corporate revolver, and so continue to press to grow deliberately and step by step towards what we hope will be an investment grade rated corporate issuer in the coming years. So been a busy year.
Yeah, absolutely. I think we're going to touch on lots of those pieces as we go through the conversation, and maybe to start off on airline performance and customer performance. We've seen obviously a really strong travel bounce back, airlines returning to profitability globally, which we sat down here 3 years ago, we would have been nearly shocked by. Can you talk to us about what your perspectives are on airline performance and how you think that'll evolve over the next 12 months?
I think there will probably be a consistent theme in our conversation today, which honestly is a lot of similarities from last year, honestly. I think many people would say there's been tons of changes. I'm not so sure. I think it's very clear that traffic recovery broadly is a clear, to where it was, or even above in some cases what it was pre-COVID. That being said, we made a very conscious decision to focus on really the Americas, North and South, and Latin America, and Europe, and some parts of Asia, specifically India, that we thought were really best positioned to sort of survive the COVID downturn and then thrive in the aftermath, and in what that new world looked like. What I mean by that is really airlines that had gone through real restructuring processes, so had cleaned up their balance sheets, gone through recapitalization efforts, whether brand new de novo or additional significant capital support from governments or really low-cost models. I continue to see a real lag from a lot of Asia, specifically, in sort of going through those, what I think are necessary adjustments to their balance sheets and to their networks. And so we've still been particularly underweight a lot of like the traditional leasing airlines in Southeast Asia and developing Asia. And we've really not done anything in China. So the customer performance for us has been so far perfect. We literally have not had, across our just under 20 airline customers, a single late payer at all. And we made a very conscious decision to be at that part of the risk profile and the spectrum. So I'd say that the airline performance for those regions broadly, without getting sort of overly specific on any one of them, has been largely really, really good in that recovering area. And I think it's still mixed in a lot of the other areas.
Yeah, and on the macroeconomic side, your outlook as to how that will continue, I guess, chatting to people this week, bit of fear of US recession next year. US is potentially in a more robust place than the rest of the world. When you look forward on that macroeconomic side and how it might impact future deals, what are your thoughts?
I've probably been beating the drum for every year of doing this that rates would be higher for longer and that recession was coming. I have been completely right on the rates being higher for longer. I have not been right thus far on recession. It strikes me that it would be an awfully impressive magic trick to avoid a recession given all of the macroeconomic headwinds. You still see inflation that is a serious problem. You see, obviously, the geopolitical issues with Russia and Ukraine that have not stopped, that have just continued and has been prolonged. You've obviously seen what's now developing in the Middle East. And you couple that with what has been an unbelievable outperform from really U.S. consumers, but global consumers, but certainly U.S. consumers leading the way, that have continued to spend. And it's really amazing in the face of such high rates and the pressures to cool the economy that they've thus far been bulletproof. And I don't know that I can really explain that. So it remains a strong economy, but it remains one that I am particularly concerned about turning into recession, and I clearly have not been right about when that would happen.
Yeah, well, most economists aren't either, so don't kick yourself out. And maybe if you guys have grown significantly and aggressively, how many years Griffin is in existence now?
We started in January of 2020. I'd say that we haven't been very aggressive at all. I'd say we've just been deliberate. We've just been kind of doing one deal after another, and it hasn't been trying to make big splashy anythings. It's been really long, slow burn origination where we've been in touch with airlines for 18, 24 months or with the OEMs on campaigns, and they've kind of, a lot of that work that we did in 2020, 21, 22 is now really delivering, right? And so we kind of continued that path, and I do see us delivering plus or minus $2.5–3 billion of airplanes a year seems to be the cadence that we're kind of moving at, and we'll adjust that up or down based on what is available in the market, what the financing environment is, what the opportunity set, et cetera. But I just think we've been kind of very methodical in growing delivery by delivery as opposed to doing anything big, splashy, trying to buy anything in the secondary market. We've been one after another.
But I guess in order to do that, you need supply. And I think as we look at the market now, we see OEM challenges, we then see engine challenges. Your thoughts on what the supply side is going to impact on your business?
I think the supply side is a real challenge, and I think it's clear that is really affecting airline planning and the fleet decisions that carriers are having to make. I certainly see that in a very acute way with the airline that we are an owner of in the Dominican Republic at Arajet. And there are real challenges when you expect airplanes to deliver in a certain time and start selling tickets, and then the airplanes are not there. And there are really, really challenging business decisions that take real creativity from the management team. And it's a huge credit to specifically that management team that I spend a lot of time with in their ability to navigate that challenge. But that doesn't change the fact that it is really, it's really hard to plan. From the leasing side, which I think is what you were asking, look, the engine and the supply chain issues are significant and they are real, and they will slow down, again, the pace of those deliveries. But I don't think that fundamentally changes the supply-demand picture on the airline side, right? They're still going to have to buy and plan for their idiosyncratic needs with their regions, with their demographics, with whoever's flying. And so with regards to the leasing side and financing side, we try to be as flexible as we can in helping to support those sort of airlines with those order books and with the OEMs to facilitate timely deliveries when we can. I don't know that that fundamentally changes anything we're doing. Meaning, like, if an airplane shows up 6 months late or shows up on time, I don't think it changes the sort of fundamental nature of what we've underwritten, a long-term lease with a specific carrier. It's just when those airplanes show up. And since we're not, beholden to sort of quarterly EPS type of measurements, like we're measured based on our overall returns to the LPs that we manage capital on behalf of. Those sort of shorter term delays don't really change the fundamental investment decisions that we're making.
Yeah, and maybe to bring you back then on the interest rate point you were talking at the start, that higher for longer piece we're in, what impact is that having on the business?
It is changing it has changed a lot of things. So number one, I think it changes the arc of the return. So like there's some amount of ongoing yield that you think about that generates an ongoing part of your return, and then there is part of the return that is in the ultimate monetization of the asset. If anything, that has shifted that sort of balance more towards the sort of exit, and really the importance from our perspective of having really attractively priced assets and having significant headroom when we look to sell from where we purchased it to where sort of market values and appraised values are, is a part of our business that we think is really favorable. Having the consistent cash flows to cover the higher cost of debt is really, really important. So we've, again, chosen quite well and picked the right partners to back with the airlines, so I think that's really good. But we have to be very thoughtful about when to raise capital. Like, we are on a clear trajectory towards unencumbering a balance sheet, an unsecured funding structure, and heading towards investment grade ratings over time as we build scale and we build track record and history. But we can't do that at completely the expense of, ever at the expense of the returns for the LPs that we're managing capital for. So it's honestly a very, very important balance that we are literally on a daily basis trying to evaluate when is the appropriate time to raise capital and in what markets and what the structure and the type of that capital is. And so I certainly do not pretend to have like here's the exact playbook of what you do on any given day, but I think it requires particularly nimble and flexible approaches to when you go to the market and how you go and where you raise capital.
Yeah, and in building to that investment grade, can you talk to me a little bit about the things you're thinking about, right? So it's obviously diversification of assets, is it the nature of the funding that you're able, the unsecured level? Just very curious around in moving on that path to investment grade, what are your key milestones?
I think it's particularly straightforward for us. We have an all brand new technology fleet, right? So we have no legacy assets that are, COs or NGs from the past generation. We have the longest lease term remaining of any lessor. We have the youngest portfolio. So the portfolio metrics honestly are already there that look better than any investment grade sort of lessor that currently is rated that way. The flip side of that is we're not big enough yet, right? Like the agencies have made it very clear that there is a certain scale that's required, and so we're going to do that in a very methodical way. We don't need to do something transformational, candidly, to sort of get there. It's really a very straightforward quarters of execution and delivering the aircraft that are in our pipeline and adding additional units that I think get us there. So there's nothing like that we are thinking about doing of, oh, you need to pivot this way, or oh, you've got to restructure your fleet, or oh, you got to sell something down. It's literally just doing a little bit more every quarter that we're already doing, and then obviously pairing it with an unencumbered, unsecured funding structure, which we will do again methodically. Like there's not like a cleanup trade, or there isn't we're going to do it with. We started off with raising sort of unsecured debt from the jump with our corporate entity, so it's not like we're raising secured debt and then at some point we'll have to do a big switch, where we have to change it. So really it's just like step after step, a very straightforward path to me.
And ballpark, when they say size of portfolio, 5, 6, 7, are they putting a billion number in front of you?
No, the agencies, as you know, they don't give you that level of precision. So you can't really get if you do this, then we give you that. That's just not how it works. But you can look to the precedents, and when you look to the precedents, you see sort of the smallest end of the investment grade rated lessors in sort of the mid 6 billion zip code, and then it goes up from there, obviously, all the way to the giants at AerCap, right? And then when you think about sort of time in business, Air Lease got the investment grade rating in just over 3 years from S&P and just over 4 years from Fitch. So, timing and scale
There's
seem
a path,
to be
yeah.
it seems to be pretty clear about like where you got to be and what the smallest end and the earliest you can be, and then it obviously goes from there. So I don't think there's not any magic about like what that looks like when we get to the right scale. I think it will be kind of obvious that we'll have been in business for that long, given that we've already crossed the 3-year mark and heading towards 4 years now. And we'll just do it step by step. So we're not looking again to do something to truly overhaul anything. It's just doing a little bit more every quarter.
Yeah. And maybe bring it on with those supply side challenges, the natural correlation is increased lease rate factors, increased asset values. How are you seeing those two metrics?
It's really complicated. And it's very difficult to be perfectly precise is the truth, because there are countervailing factors. The higher interest rate environment, I think many in our space believed that it would be a temporary, elevated rate environment, which I think is proving to be wrong. And I think it's made it very difficult for smaller sort of players and newer players to really fund without access to bigger facilities. And we kind of have just gotten to the cusp of those larger facilities and more flexibility with unsecured capital and the size of the facilities. So I think we've kind of just gotten to that sort of early edge of that part of the spectrum. I would suggest that part of your previous question on supply, slowing down delivery rates when we thought we were going to get back up to sort of a normal ramp with Boeing and Airbus deliveries, has in some ways reduced that supply. But even if the capital is also reduced, it's kind of not moved rates up probably in lockstep with interest rates. So I think interest rates have moved up faster than the lease rates have moved up. People always talk about a lag effect. I just don't know that they're correlated one-to-one. I still think there's a view that if you can look through, today's rates, that you will be able to have a, in the money type of lease, however many years down the road, whatever your forecast is. At the same time, inflation has been very real. The cost of maintenance increasing is very real. The speed of which those maintenance events or those sort of fixes are taking place are just increasing the costs throughout the system, to me, which is a massive buoy to values of assets. So there's a little bit of, like countervailing forces where in one sense, you've got a higher ongoing cost that needs to have an adjustment with the rates. In another sense, you've got reduced supply that's pushing values up, and then the sort of other sort of buoy again is that cost of maintenance and the speed of which that's happening. So there's a lot going on, and it's tough to be super precise about where exactly it is. So those are all the factors we think about.
Yeah, and it goes back to your point you made earlier around the fact that your returns here are yes to the lease, your lease rate returns, but your residual value play might make up more of your return in time, right? If those values piece is pushing.
Look, we made a very, very conscious decision, and it was deliberate during COVID, was to pick these types of carriers, right? It was to pick carriers that were going to be in a position of really, really thriving. What that meant was we weren't chasing a little bit of sportier credits that could have had an extra however many basis points of lease rate factor that kind of go with it. Time will tell if that was right or wrong, but so far I think we've been spot on, because we have not had any payment challenges. We have not had any issues with sort of monthly receipts that we receive on the leases, which has made it very easy to sort of say to the banks, continue funding what we're doing, because we are like clockwork making those payments with the carriers that we've underwritten. At the same time, we also made the very conscious decision of trying to pair with those types of carriers, take advantage of their purchase prices. So a lot of times there are the sort of higher price but higher lease rate type of transactions. We have stayed away from those entirely. We have been really focusing on entry price as attractive as we possibly could, and commensurate market lease rates to go with them. And so our book, relative to sort of the appraisers that we've used to sort of measure it, which are Ascend, MBA, and IBA, we're a full 10% inside of the appraised values for those assets. And so from my perspective, that's an incredibly risk-averse way to be thinking about the business. We're positioned, if there was ever an issue, to sort of move things around the globe without having a high basis or really any degradation in those rates that we would be charging. And I hope that that positions us nicely to, at some point in the future, when we are looking to monetize for the LPs, to be able to monetize efficiently. So without predicting what the numbers are, I think we have a really, really good hand that we've built, again, one by one, deal by deal, very, very deliberately, as opposed to sort of buying a portfolio of whatever other people did. So we've tried to be very methodical about it.
Yeah, and maybe focusing on the liability side, you mentioned tapping that unsecured market. You have the traditional aviation banks, the unsecured market, the alternative lenders, and then say capital market structured product. Your thoughts on the health of the overall debt market in aviation finance?
My perspective is the market is very healthy. It's just the rates are higher. Like I don't see like structural issues with buyers or with funds that are unwilling to put money to work. It's really a fundamental, like, books and lease rates don't work for the current cost of capital in a lot of cases. So whenever the question is like, oh, is the ABS market reopening or whatever, I don't think the ABS market ever really closed. I think it was just that our industry had really priced lease rates at a level that don't make sense when you add hundreds of basis points of sort of the base rate that then the spreads are kind of tacked onto. So I don't think there is a structural issue with the credit markets in general. I don't believe there is a lack of supply of that capital. It's really just like, can you make it work where the current sort of water level is? And the answer is it's really tough.
Yeah, and maybe on the investor side then, to take your perspectives, if you look at aviation, it's had its kicks over the last few years. COVID, an outside kick. We had Russia probably impacting aircraft leasing in a very significant way. The virtues of aircraft as an asset class, how do you think it currently stacks up?
Relative to what?
Well, say other transportation classes. So if you're fighting for capital, that there are options for investors that are out there. Is aviation, does it remain an attractive asset class? Has it been adversely impacted over the last few years? Or does the resilience mean that, if anything, it's as attractive as ever?
Let me give two answers to that. I think the first answer would be, from a credit side, I think the performance of the aviation platforms was spectacular through COVID, right? I mean, I think the sort of ability for everybody to cover their obligations, to access capital when necessary, to pay bondholders of most formats and flavors back was really, really good. The equity returns, however, may not have been so good, right? So I think it's a tale of two sides of that asset. You certainly saw E-note buyers be challenged based on some of the portfolios that were out there. I think a lot of the asset managers have posted particularly rough returns, given the amount of amendments, restructurings, repossessions, reconfigurations, all of that, because while you can service the debt obligations that go with them, ultimately, like, who your shareholders, LPs are they actually generating a return? I think in a lot of cases, those numbers were weak. So I think as a general matter in the world of private equity and capital raising, a lot of the large allocators, if they had lots and lots of different funds, and this is not an aviation comment, This is a more broad market comment, had lots and lots of different funds that they were lots of strategies they were sprinkling capital to. What has been a very clear theme is that they are narrowing the number of managers that they are backing. So I think aviation remains very attractive, and I think there are lots of different strategies, as you will certainly see every time you do one of these or a series of these types of interviews, of what part of the value chain people want to invest in and why they think that is better or worse positioned. I've always been a believer that airplanes are good. They just have different risk profiles depending upon where you're investing in it, and they all deserve different credit structures and specific capital structures to go with those assets, depending upon what the risk profile is, whether it's new, mid, end, regional, engines, whatever. There's all a need for that fundamentally, but how you actually structure them is really, I think, the difference between the sort of winners and losers on that side.
Yeah. And maybe to bring it big picture leasing for a moment, we've seen the long-term proportion of leased assets has generally ticked upwards, and in the last 3 years definitely had a spike.
For sure.
Lessors stepping in a real way, and a deepening of relationships. I talked to you, I talked to lessors. There has definitely been a deepening of relationships between lessors and airlines. That said, we got a lot of airlines generate a lot of cash at the moment, and probably, to that point at supply side, maybe wanting to own more of their assets potentially. Your thoughts on where does that? Do we continue to gradually tick upwards? Have we hit a ceiling? What are your thoughts?
I've literally never had a view on that, because I don't believe there is some like theoretical right answer on how much an airline owns versus how much is in the lessor community versus how much is government backed. Like, there to me isn't, like, I've never seen a credible, the right answer for in the long term this to land on is a number. I have a feeling that this is going to be cyclical, where there are going to be times where it's very efficient for airlines to raise capital, or they're flush with cash and they'll want to own more. And when capital is more expensive or there are challenges, then they will look to other sources and tick that up. So I don't believe there is some kind of we're heading to like some kind of a limit where it's like, okay, we're when we arrive at this number, that's in balance. I believe it's going to go up and down over time. So I don't have the right answer is 50 or 60 or 42 or whatever it is.
Yeah, and maybe again, big picture leasing, if we think about the importance of scale. And as you say, you guys are making a particular play to become scaled and have that access to the investment grade unsecured market. Has that become more important, particularly in a heightened interest rate environment where you need to be managing your cost of funds with every facet that you can?
So again, I think there's multiple ways to think about this. There's some scale that's required. How much scale? I don't know the right answer to that. Like, how big is big enough? When you look at, the spread differential today between the highest rated issuers and the non-investment grade issuers in the corporate, I mean, the spreads have compressed, or the difference in yields have compressed to a point that's negligible. Like, I mean, it's a 200 basis points of a differential between like maybe 250 between the highs and lows, and then there's other times where it's 500 basis points or 600 basis points, right? That you kind of can go up and down on that kind of spectrum based on where base rates are, where spreads are, and how that evolves. That can be a massive advantage at times, and that can be less of an advantage at times. So I think the answer is it depends.
Yeah.
I would say that like scale from my perspective is having a large enough team to be able to navigate any challenges that you sort of come across, how to underwrite appropriately, having enough of sort of a credit function, et cetera. And so when you get to a certain size, I think that's fine. And then there's different strategies that you can, put into place to sort of be specific for what your team is looking to do. I guess I didn't set out to build something that was of a specific scale. Like, I didn't set out to be like, we're trying to get to X billions of dollars. We set out to try to make thoughtful investments, and the team has grown organically and the portfolio has grown organically, and I continue to see that evolving over time and growing. But I don't have like a theoretical, we're trying to get to some number.
Yeah, and do you think we might see some challenges with asset managers, right? So again, as we look at this market, and to your earlier point on where rates have gone and adjusting to those rates, it seems anecdotally, you chat to some of the asset managers, and marrying the right returns and getting your hands on the right assets seems challenging. So I look at the large balance sheet lessors, and you can kind of see a path to growth and probably taking more of the market. Would you have any concerns for asset managers?
I don't want to pick on anybody. So I think there are challenges for large guys. I think there are challenges for small guys, and they're just different challenges. Managing a balance sheet where you own everything in the market presents lots of challenges, and managing a smaller book that doesn't have the same access to capital presents different challenges. So I think there's challenges in both sort of parts and everything in between. I would suggest that I think the question is really, I think your question is more specifically on access to funding as opposed to managing an existing book, because
it's probably packaging. It seems to be harder now to package something.
Yeah, until rates until lease rates readjust or interest rates readjust, right? So right now there is almost like a little bit of the system's a little bit clogged for that part of what was, I think, really well functioning in the 2010s, certainly by the middle of the 2010s, and that part is not really moving the same way. So I mean, it's a question. I certainly haven't seen people yet like raise the white flag and say we're throwing in the towel. Like, you haven't seen true capitulation yet from people who own books. I mean, there's certainly been some distress. You've seen sort of like the Intrepid cum Voyager, that one kind of came out. But other than that, I don't think there's been like I guess Wings changed hands with that portfolio. But again, there hasn't been like that many like, we're done. Take the planes and someone go, do it in a distressed type of sale. So, the longer this goes, maybe you start to see that. But I do not see yet the we're throwing in the towel and that type of capitulation. We'll see.
Yeah, I think clog was an appropriate terminology around it, right? It just seems there's a bit of stuck in the muck for some of them at the moment, right?
There's not a lot of great options, right? Where rates are where they are, and then you got to add amortization, and yet you've kind of got the lease rates that are where they are, and so how quickly can you reprice those when those things renew? And yes, there's certainly demand in the secondary market for lease extensions right now because of the delivery delays. So I think that's favorable, but you don't get to reprice every year or every 6 months. You get to reprice periodically. So it's slow, and so I would suggest that it's just it's clogged. It feels like it's slower in that sense than sort of the velocity maybe that was happening in the middle to late part of last decade.
And maybe just briefly on the environment side, Ryan, you guys have an incredibly young fleet, and therefore if there was a benefit to be had from an emissions perspective in funding a fleet, you'd like to think you'd get it. Do you think you're getting any bounce?
None. I would love to give you a different answer.
Yeah.
I mean, I think insofar as like we're trying to focus on the airline side of it, right? Which is, these are the types of planes that they need, and these are the types of planes that are going to be the backbone of their sort of businesses for decades, right? And again, in a lot of ways, and I've used this before, sometimes it's better to be lucky than good in timing. Like, I didn't set out to sort of start a new business 3 months before COVID, and I didn't set out to start the business specifically at like the early days of like what I think will be a pretty long-tailed product cycle. Like, the last decade was the introduction of all these new types of aircraft that were replacing old ones, and I would say that like the R&D right now certainly doesn't look like there's a lot of new technology replacements on the near-term horizon, right? So I think the sort of models and the production that's sort of currently happening looks to be pretty sticky. Like, this will be kind of what the aircraft manufacturing looks like for the foreseeable future. And so we feel very good about that part of the product, and we feel that part of our book, and it's very, very risk averse because they need the planes. They're going to fly those planes for a long time, and we think there'll be lots of market demand for it.
Yeah, no, I think it's fair right now. A common theme, something will happen, but it's not happening yet, right, on the financing side.
And I just don't lose a lot of sleep on that part of our business. Like, we're definitely trying to be thoughtful about when to finance, how to finance, when to put new money to work, like where are the right opportunities to do that. But I am in an incredibly fortunate sort of seat that our team, I think, has made really, really good investment decisions thus far. So like, we have had no dislocation, we don't have any repossession issues, we don't have that. Of course, over however many years that will inevitably be a part of it, but right now that's not something we're worried about.
And just in closing, Ryan, as we sit here, as I say, in October time, looking out over the next kind of 12 months, what are your optimism levels like?
I think caution is probably the better way to put it, rather than overly optimistic. There's clearly business to do. Like, just because the sort of rate environment is high, and just because there's geopolitical issues and challenges with the economy, doesn't mean the business stops, right? Like, business still continues to get done through cycles. We just want to be very, very cautious in where we go. That doesn't mean, and caution is sort of, I guess, all relative, but we'll continue to focus, I think, on the same things we've been doing, which is trying to provide creative capital solutions and forward capital commitments to airlines that we think have, inherent demand and need for their markets and refleeting or growth or whatever it's for, and continue to sort of do more of that. we'll continue to raise capital, hopefully in a very pick good moments and windows when we can do that, and we'll try to be trying to match those sort of when we're looking to put money to work and when we're able to raise more money to sort of clear up capacity for our different credit lines. And we'll watch credit very, very closely. So I think that function and making sure that we continue to do really, really deep dives into financial performance, into the balance sheet metrics, into where potential weakness could be, is probably where we'll continue to spend a lot of our time.
Well, I wish you the best of luck in doing that, Ryan. On behalf of KPMG and Airline Economics, I'd like to thank you as always for your insights, and I do hope you have a very successful 2024.
Thank you so much for including me as usual, and likewise.
Thanks.